All right, welcome everyone to Algo Trading, a stop loss potential alternative. I'm Kevin Davey. Thanks for joining me today. It's going to be kind of interesting what we talk about. And for those of you who either saw the first video or read the first part of the article, you'll know what we went through. And today I'm going to talk about all the other parts of the 5-part article. So, you know, just so you know, there's no sales pitch here. I'm not going to be a used car salesman trying to sell you something. I'm going to give a short intro. I'll probably mention my course a couple times for those of you who are interested, but it's not a sales pitch. And the big thing we're going to talk about today is talk about some of the other things I did with looking at a alternative to the traditional stop losses. Then we'll have time for questions and answers and the book giveaway. And I see I did not update correctly one of my slides here. So let me do it. Obviously, today is not Friday, March 1st. Today is Tuesday, March 12th at 1 p.m. So if you're listening right now, it's live. Otherwise, you're listening to a recording. So the book giveaway, it really won't matter. I just want you to make sure that you realize you are watching it live. So with that, let me erase that. And like I said, I'm just going to mention my workshop in case you're interested. Uh, a lot of the research I do, I share with Strategy Factory students. So this is just a sample of some of the research, but it recently won first place in the Technical Analysis of Stocks and Commodities Magazine Reader's Choice Award. So for the best trading school. And I beat out people or companies, not even people, companies like TradeStation, Thinkorswim, Warden Brothers. I beat them all. And it's just me teaching. So that gives you an idea of the level of instruction I give. All right. So first, our disclaimer, don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. So the article, if you're interested, can be found right here. So you can hit that QR code, pull it up on your phone. I'll be going through it in a second once I switch screens. And that happens right now. So let me do that. So you should be able to see the article on the screen. If you can, somebody who's watching live, just type a Y, just so I know it's live. I know it's live. There you go. Thanks, Stuart. Okay. So there's 5 parts to this article, and I talked about part 1 in the first webinar, and that was I gave a general discussion of what we were doing, and I gave some of the first results. Today I'm going to go through parts 2, 3, 4, 5, and then do a conclusion. You could see from the first part, if you read it or watched the video, I did a whole lot of research on this. And once I did that research, I could have just stopped there. Actually, it probably would have been better given what I'm going to show you today, but I didn't. I kept going. I kept wanting to try some different things, try some different ideas. I actually took some ideas that some early readers gave me, and I decided to see if I could improve on things, but I'll show you those things. So we're going to talk about part 2 in a second, but just to sum up, in part 1, what we found was if you had a monthly profit of $2,500 or $5,000 per contract, and then that once you hit that, you closed all trades and stopped trading for the rest of the month, that on a good number of strategies was a better approach than continuing to trade. And the way I kind of explained it, I think what was happening was what's called a ratchet effect. And you can click on this video and watch it, where what ends up happening is the profit locks in at a certain point and then waits and then jumps up again and waits and jumps up again. And so it's kind of an interesting way to trade a strategy, and you might want to look at it. So if you didn't read part one, I'm going to assume you did, just in the interest of time here. Just watch that and then see what you think. So what I had found in part one was a dollar-based profit was good. If you have a strategy, after you have $2,500 or $5,000 of profit in a month, just stop trading for the rest of the month. Well, one of the things that bothered me, and it also bothers a lot of people, and that's why I did this, is this, but that's a dollar amount, and shouldn't it be related to the volatility? Shouldn't it be related to the market it's trading, and all that? And I decided to look at average true range for this as part of that. And instead of doing a dollar amount, I did an average true range. And by the way, I'll mention for people who have questions, just type them in as they come up. I'll get to all of them at the end. I'll just kind of go through them. And that'll kind of keep us on focus of going through this. So what I did here was I tried some different average true ranges, and you can see this is TradeStation code, but I'm saying if the current equity minus the equity at the beginning of the month, in this case, is less than minus 10 ATR, and I convert it to dollars, then you stop trading for the rest of the month. Okay. And so I have 4 different cases I'm running here. Some 2 are with losses, and then 2 are with gains, certain amount of ATR gains. So that would sort of be like the dollar profit, the last 2. And that's kind of what I was looking at. And unfortunately, what I found was it didn't really help, and it didn't really make things better. And in fact, you can see here, right here, there's really not much of a difference with the ATRs. So I was using 10 ATRs and 25 ATRs because I thought on a monthly basis that might be a good value to use. I wasn't really sure. So I decided then to look at other values of ATRs, and that's what I show here. So I went from 3 ATRs up to 100 ATRs, so a wide range of thresholds. And again, I looked at the monthly loss and the monthly profit. And the bottom line is you see a lot of red here, right? And what that means is it's not as good as doing nothing. And because that's the case, there's nothing that jumps out at you that says, oh man, this ATR approach is better. Okay. And that's kind of what I was looking for with all this. I'm not looking for absolutes to say, oh, hey, you will increase your profit by 2.3%, and that's good. I'm looking for like general trends, general observations. And when I see blue, green and red mixed together, it just means the results are kind of inconclusive. And that's my conclusion with the ATR, is that the ATR approach to this study does not seem to improve the performance at all. Okay, so that was a dead end. Well, then I said, maybe I'll take the dollar amount and use an ATR with it. Okay. And why would I do that? and that's in part 3. Well, if you think about a lot of futures markets, you've got some of the big guys like crude oil, gold, the ES, the NQ. Those are all like big movers, right? And then you've got some smaller markets, like some of the interest rates, especially maybe like the 5-year notes or the 10-year notes. Uh, Coffee, maybe. Well, coffee's probably in the big one. Sugar is probably in the small one. Corn, maybe wheat. Soybeans would be in the big one, but some of them just don't move a lot. So the question is, well, why have a $2,500 or $5,000 monthly threshold for those smaller markets? And so what I did here was I decided to use the ATR to reduce that threshold by half for the smaller markets. So for the big markets, I'm keeping it at $2,500 and $5,000 for the profit. For the smaller markets, I'm going to look at $1,200 or $2,500. So I cut it in half. And you can see I do that here, where if you go back and look at the code previously, it didn't have this dollar multiplier with it. And all the dollar multiplier is it usually equals 1, but if the 30-day or 30 bar average true range is less than $1,000, then it makes that dollar multiplier 1/2. So it would make all these values 1/2. So that was my attempt to see if maybe a different threshold for smaller markets works better, which going into this, I kind of really liked, because it just feels kind of weird to say, hey, corn, go for a $5,000 profit. Oh, yeah. And crude oil, which is a lot more movement in that market, that should be 5,000 too. It just doesn't feel right. Okay. So I did it. And with the monthly loss, it was kind of inconclusive. And the monthly profit, though, you notice this is all green. Well, that's great. You say, okay, well, using this with the profit on the profit side definitely improves things compared to the baseline, which is having nothing. Okay, pretty cool. So I then compared it to the part 1 results. So if you look at this, part 1 results are over here, and you're comparing those to these new results with this ATR twist kind of thing to it. And you can see you'd have to compare. Let me erase this so you can see exactly what. So you'd have to compare this number to this number. So part 1's better. This number to this number. Part 3 is better. And then these two numbers and these two numbers. So 3 of the 4 times, part 1 is the winner. Okay. So part 3, this ATR twist works. It's just not as good as the original one. Okay. So my conclusion here is, hey, you could use it. It's good, but it's still better just to have that dollar amount, which I get it. It just goes against everybody's thinking of, hey, why should some markets, smaller markets, be treated the same as big markets? Now, maybe some of the things you guys will do on your own, you'll conclude that this is better. I'm just showing you what I found. So I like this approach better. I like this ATR approach better, but the data doesn't support what I tested, that it actually works better. Okay. So that's part 3. Then, and this was partly somebody was asking about it. So I decided to do something a little bit different. We said, hey, a $5,000 profit target. That's our monthly profit target. Well, what if I made that a variable, something I optimized and ran it with the walk forward and everything? So I decided to do that. And this one, I only tested with a couple of the exits. And I'll show you, let's see, the easiest way to explain those results are here. These are just stop and reverse strategies up here. Basically, with some of the strategies, this approach worked great. With other strategies, the reverse of those strategies, it didn't work so great. It did the opposite. So didn't really work too good with that. And then I had a version where I ran a catastrophic stop. And again, the results conflicted. Some strategies were good, other strategies were really bad. So my conclusion, this doesn't really help. So optimizing for this monthly profit just doesn't help. So again, we're back to, hey, just use that $5,000 monthly profit target and turn off the strategies. So it's kind of interesting that the simplest one of everything I've tested so far, which was what I tested initially, worked the best. Okay. So that's kind of where it all ended and what I was planning to finish and just say, hey, just go with the results that you found in part one, the conclusions, then you're good to go. And then a couple readers of that first part said, well, maybe it has something to do with when you're starting and stopping during the month. Maybe there's some seasonal effect. What if your strategy stops one day before the end of the month and then, you turn it off for one day? Maybe you should turn it off regardless for half a month, or it's, something like that. So that led me to part 5, which was one final attempt at this. And I decided to test for them where it's not based on a month, the results for the current month. It's just based on the last month worth of results. So in mid-March, where we are now, I go back and look from mid-February to mid-March. I don't look from March 1st to now. So that's a lot different. And so I thought, well, see what we see. And here I only show the comparison part 1 to part 5. So part 1, remember, was the initial good ones. And part 5, so those are part 1. And then part 5 is this new approach. And you can see the new approach does pretty well. Okay. But most of the time, part 1 does better. So I'd kind of conclude that part 1 is still the winner, which is crazy. So it's like everything I tested, nothing was better than part 1. And it's still the winner. And you might say, wow, that's kind of unfortunate. Well, oh no, it's really not, because the neat thing about doing this is you find out things that don't really help you. And it's all a path of discovery, right? Of, hey, here's what works, here's what doesn't work, and things to stay away from. If you have my cheat code book, you'll notice the same sort of thing. I do studies. I don't really know what we're going to find, but I let the data lead us to a path and say, hey, the data says do this. Data says do this. And so in this case, the data says this part one, the results of part one, way back when, are still the ones to go to. So the conclusion here is this approach I use does not justify having it. Okay. All right. So let's kind of wrap it up as far as all the things I looked at. And these are basically all the different kind of tests that I looked at and what my verdict was, should you use it? Should you not use it? And the dark green are the best ones. And the lighter green are other ones you should consider using. But a lot of them, the ones with ATRs, anything with the loss switch, where you lose a certain amount in a month and then turn the strategy off, that doesn't seem to work. But this is a good table to show you what you could use. Now, one thing that's probably important, I mentioned it earlier in the article, but it's important to bring up. If you have this super great strategy, the holy grail of strategies, okay, I get it doesn't exist, but let's just say it did. Just think theoretically, if you had a perfect strategy that was super great at making money, would it make sense to cut it off at a certain point every month? No. A super great strategy, it would make a lot of sense just to keep trading it, right? Because it's just going to keep going up. You're not going to have significant or any drawdowns. So for perfect strategies, you don't want to do this. Now, what about big losing strategies? Ones that always lose? Well, probably either the loss switch or the profit switch might change the results a little bit, but it's not going to turn it into a winning strategy. Where this approach works is in the middle with strategies that are normal, that are ones that typically I develop, ones that my students develop, that using my process. Those are the ones that this approach can help you with. So keep that in mind, is that's where we're aiming. We're aiming for that vast majority of middle strategies. But if you have the perfect strategy, this doesn't make sense to do. Okay. So that's kind of what's recommended and not recommended based on this whole, few months long study. And the code I would include, you have all this code that helps you turn the strategy on and off. You have a second part of the code that will tell you if you've turned off the strategy to actually cease trading. That will help cease trading. And then you'd have this code with your entry rules in here. And it would only work when you were allowed to trade based on the monthly rules. So otherwise you won't enter any new trades. And that's kind of what it all comes down to. So it's a pretty long story, and I tried a whole bunch of things, and there's other things that I didn't even include in the article that I tried. But using this monthly profit switch somewhere between 2,500 and 5,000, that seems something pretty good to use. And it definitely has improved strategies. And what's funny is that as I was doing this, I actually, I mentioned it down here. I ran this whole study, and then I was starting a new study, and I decided just to use some of these results, and completely different strategy, things were just totally different. And guess what? It worked on those too. It worked on some new strategies. So it does seem to work, and it does seem to help out. So what I recommend is just going forward, use it on strategies and try it out and see if it improves things. One word of caution, if you go backwards with existing strategies, uh, either do them all or don't do any. And what I mean by that is, let's say you have 5 strategies and you go back and you test this approach with 5 strategies, and on 3 of them, it makes it better, and 2 of them, they're about the same or maybe worse. Don't just take the 3 that made it better and say, well, I'll use this with those strategies, but I won't use it because with the ones that make it worse. Because now you've just optimized for it, and that's dangerous. So either decide up front, say, I'm going to use it for all of them regardless, or I'm not going to use it at all for those existing strategies. I'm not a big fan of taking existing strategies and modifying them. I think there's times you can do it, but it's really kind of dangerous. So just be careful of that. Okay, so that was kind of quick. I wanted to leave more time for questions and answers just because uh, I realize this isn't like standard Algo 101 type material. This is kind of advanced material. And there's roughly about 40, 50 people here live. And you should applaud yourself. This is advanced stuff. This isn't the material that you see on YouTube ads where they're like, oh, just use this candlestick entry and this will work great with your algo trading. This is a step way beyond that. And you guys need to realize that. Okay. So again, if you like this kind of stuff, this is the kind of material you'll find in the course, along with just how to build strategies. So obviously there's a lot to it. You can just hit that QR code and go to it. I consider it the master class in algo strategy building. I don't think anyone's doing a lot of the things that my students and I are doing. All right, so let's kind of go through questions and answers, probably 10, 15 minutes, and I still hope to get you out before the top of the hour. But if you have questions on this study, any of the parts of it, feel free to ask. Or if you just have some questions in general, I'll be happy to answer those as best I can. All right, so we had some questions from Adam, and so the first one, he says, Howard Bandy discusses the risk of ruin and the risk of retirement. Your approach is basically a monthly risk of retirement threshold, which keeps you out of the market and giving back profits. Yeah, in a way that is. And let me, for those of you who were around the first time, I want to show this video again, or those of you who weren't around it, because I think this is kind of what it's doing, what this approach is doing. So let's just watch this video. There you go, carnivore. Okay, all right. So anyways, I'm gonna mute this guy just so you can see it, but I think everybody can see this screen, right? If you can, just type a Y. I just want to make sure people can see it. Okay, so first what we're doing is you can see that yellow gold staircase is moving down, right? And consider the black ball your equity. So this is a losing strategy, right? Your equity's just going down. Okay, nobody can deny that. Now, let's take another strategy. This is a green one. Now, this one has some wins, but the losses are bigger than the wins. So it goes up and then falls down, goes up, falls down. And you can see eventually the ball, your equity, goes to zero, and then it goes back up to the top just to show how it's going down. Nobody would deny that ball's moving down. So both of those strategies, the ball's moving down. Okay. Now, if you put both together, you're going to get this. And this is what I kind of think, or the way I visualize what's happening here. You have a strategy that's making money, but you're turning it off. And so one of these ratchets, there's two ratchets there, the gold one and the green one. One is cutting off your profit at a certain point to prevent it from falling back. And you end up getting this effect where your equity is actually climbing. It stops and then goes. And now I might be full of it that this is what's really happening, but that's kind of how I envision it. So what Adam is saying is, and what Howard Bandy, who's a trading educator, he's written a bunch of books, is you get out before you have time to give back profits. And it's seems to hold for this. So interesting comment. Do your dollar amount results extend from 2K to 5K to 10K to 20K to 30K for a monthly profit goal? No, I didn't look at that. And because I was looking at individual strategies, I thought 2.5K and 5K were decent for a strategy. To go up to 10K to 30K, you'd probably want to look at maybe like on a portfolio level. And maybe this works with the portfolio too. Okay. David said, have you found any reliable exit indicators? Should I stop looking for reliable exit indicators? I mean, there's no reason why you shouldn't, or you should stop. Different exits work well in different situations. I wrote a couple articles that are on my website about exits. And for me, everything I tested, the best one was a stop and reverse, which means you're always in the market. And if you get a signal, you just reverse the position. That seemed to work the best. Now, there's cases where a stop or a profit target works the best, but a lot of times the stop and reverse works good. The other one that I found works pretty good is just a technical indicator. We always use technical indicators for entries, but there's nothing to say you can't use it just to exit. A moving average crossover. Everybody says, oh, that's when you buy. Well, maybe you set it up so that's when you exit, either a long or short, depending how you do it. You don't necessarily have to go in the opposite direction. You can just use it as a technical indicator type exit. So that's something else to think about. Adam asked, what would be the effect if your trading month started on the 15th of the month? Well, that's what I was trying to accomplish by have a rolling month period. And so within that test would have been sometimes where it stopped or started trading halfway through the month and that kind of thing. And the results, like I showed you, that was part 5, didn't jump out as being, oh my gosh, they're so much better, that kind of thing. So it could be worth doing if you're so inclined. I don't know if you really get much out of it. Okay. Chris has a question. And didn't the variable monthly profit switch include the fixed monthly profit of 25 and 5,000? If the answer is yes, which it is, then how could we conclude the latter leads to profits, but the former does not? Meaning, how could you make that conclusion? So let's go back to that article because this wasn't something I talked about too much. Whoops. Just close my window. All right. So that was part 4. And to describe what I did, I think this will answer Chris's question, is I didn't include the code for it here, but what I did was I made this a variable one throughout the test. So meaning it could be $1,000 for part of the test, it could be $2,000 for part of the test, it could be $5,000 for part of the test. So it would vary based on the optimization, and it was done via walk forward optimization. So it would change throughout time. And that's why you're seeing it not be as good as just having it as a static level. And like I said, it seems to work in cases, but it's not like a consistent type result. So that's why I didn't use it. Okay, hopefully that answered that question. Okay, well, it looks like I've probably uh, just boggled some people's minds, especially if you didn't watch part 1 or see the part 1 of read part 1 of the article. Eric has a question. Is it realistic to perform the number of back tests like you did manually? No, it's not. This would take you forever. And as I mentioned, the only reason I can do it is there is software that I used somewhere. I show it. It's called Multi-Walk, which was written by a former student, current student, who took the course probably about 8 years ago. And he took the course and he really liked what he found, but he was a computer programmer by his profession. And he said, this is great, but it's just slow because you have to insert a strategy on a chart, you have to run the optimization, you have to do the walk forward. It takes a lot of effort to even run one. And what he did was right around that time, maybe a little before, TradeStation started offering access to what they call their optimization API. It's basically a way to use their optimizer to get results without having to optimize via a chart. And so what he did was he took that, combined it with a ton of his own programming, made a little trading app that sits inside of TradeStation and allows you to run thousands and thousands and thousands of back tests and, record all the results, and then you can analyze them. And that's what I use to do this study. Terrific tool. It's only available to students who've taken my class because it has a lot of my process built into it. And but it comes with the platinum class, it actually comes free. I go and I buy you a license, and so the programmer's compensated for his time. But this is a great tool. So yeah, what you're saying is, Eric, is doing it manually just not an option. This would take forever. And it's funny because before this was available, a lot of the things I've been doing the last few years with Multi-Walk, and before that it was called Multi-Op, I'd been wishing for like 10 years that I could do it. I was like, man, only if I can run more back tests, I could really see some more things. Um, and now I can. So, and that's what I share here and also in the course. The course has, there's one thing in the course, for example, it talks about 50 million back tests that I ran to come up with a certain process. So definitely is a good tool if you're going to be doing a lot of back testing. All right. Well, looks like we're a little early, but it doesn't look like there's any more questions. So what we'll do is we'll just go on to the book giveaway. And what I'll do is I'm going to give a 4-pack of my 4 latest books to the third and fourth correct answer. And if you're already a student, if you already have these books, don't bother answering because there's no point. You already have them. Everybody who's in the platinum class already has these books. But if you're the third or fourth correct answers, you'll then get a copy of this. So I'll count down from 3, go 3, 2, 1, and we'll go with it. All right, ready? 3, 2, 1. If you built a strategy today, what would you not include? A monthly stop loss, B, an ATR profit target, or C, a monthly target. And the correct answer is actually A or B. You would not include a monthly stop loss. You would not include a monthly profit target. What you would include is C. So this one I made it real easy for people. It's either A or B. And Federico was A. He was number 1. Too early. JS was number 2. Saeed was number 3. He had A. And Chris was number 4 with B. So Chris and Saeed, just send me an email, kdavey@kjtradingsystems.com. Let me know you won the books, and I will get those to you. All right. Well, that's it. Doesn't look like we have any more questions. I want to thank you all for attending, and this is Kevin Davey signing off. Have a great day, everyone.